I need you to meet a woman named Carol. And I need you to understand that on the morning of September 18th, 2024, sitting at her kitchen table with a cup of coffee she made for one instead of two, Carol opened an envelope from the Internal Revenue Service and discovered that the United States government had decided her husband's death was a taxable event. Not for the estate, for her, for the surviving spouse, for the woman who just lost her partner of 41 years. And the bill, when you add up all the quiet, compounding ways the system reaches into her bank account now that she's filing as a widow instead of a wife, comes to more than $40,000 over the next decade. And that is a conservative estimate. Carol is 68 years old. She and her husband Robert had done everything the financial advice industry tells you to do. They maxed out their 401ks. They kept their expenses reasonable. They paid off the house in 2019. They had $1.8 million in retirement accounts, a combined Social Security income of about $65,000 a year, and a plan that their advisor told them was rock solid for the next 30 years. And then Robert had a heart attack in his driveway while bringing in the trash cans. And Carol's rock-solid plan shattered into 1,000 tax traps that not one person, not the estate attorney, not the funeral director, not even her financial advisor in the first 3 months after Robert died, thought to warn her about. Because here's the thing that nobody tells you when you're sitting in those retirement planning seminars holding hands with your spouse and imagining your golden years together. The U.S. tax code is specifically structured to punish the surviving spouse, not to support, not to ease the burden, to punish. And it does so in at least 6 simultaneous, overlapping, mathematically brutal ways that all detonate the moment you go from filing jointly to filing alone. This is what I call the widow tax trap. And before I show you exactly how it works, exactly where the trap is set, and exactly how you can disarm it before it's too late, I need you to do something for me. I need you to hit that like button right now. And I know everyone says it. I know it feels like YouTube noise. But let me tell you why this one matters. This topic, the financial destruction that happens to surviving spouses, is something the retirement planning industry does not want in front of your eyes. Not because it's false, because it's true. And because the solutions require work they don't get paid for. The algorithm does not promote content that makes retirees anxious about the very plans they just paid someone $3,000 to build. The only way this reaches the people who need it, the couples in their 60s and 70s who still have time to restructure before the loss happens, is if you push it up the rankings with engagement. So hit the like button. Do it now. Come back. Because this gets worse before it gets better. Let me show you a number that should be on the front page of every retirement planning book in America. And instead, it's buried in census data that almost no one reads. According to the U.S. Census Bureau and the Social Security Administration's actuarial tables, in a married couple where both spouses are age 65 today, there is roughly a 75% probability that one of them will outlive the other by at least 5 years. 3 out of 4 couples. And because women statistically live longer than men and tend to marry older partners, the surviving spouse is a woman about 70% of the time. That means the retirement plan that gets sold to married couples, the one built on joint tax brackets and combined Social Security income, has a 3 in 4 chance of catastrophically failing halfway through. Not because the investments went bad, because one spouse died and the tax structure of the survivor's life was instantly rewritten by the IRS in the most punitive way possible. And here's the part that makes my blood boil. When Carol's advisor built her retirement plan, he ran Monte Carlo simulations for market volatility. He stress tested for inflation. He calculated required minimum distributions 30 years out. But he did not once, model what happens if Robert dies first and Carol spends the next 15 years filing as a single taxpayer on half the income thresholds. That scenario, the one with a 75% probability, was not in the plan. So let me put it in the plan. Let me show you exactly what happened to Carol, because her story is not an outlier. It is the statistically likely outcome. And if you are married and you are watching this, one of you is going to be Carol, unless you do something different than what Robert and Carol did. Here is what changed for Carol the moment Robert died. Not over time, immediately. 6 different traps, all springing at once. Trap number 1, the tax bracket ambush. When Robert was alive, Carol and Robert filed jointly. Their combined income, about $65,000 in Social Security, plus another $40,000 in IRA withdrawals to cover their living expenses, gave them a total taxable income after deductions of roughly $75,000. Filing jointly in 2024, that puts them comfortably in the 12% marginal tax bracket. The 22% bracket for joint filers doesn't even start until taxable income exceeds $89,075. But the moment Robert died, Carol lost the joint filing status. Now she files as a single taxpayer. And for a single filer in 2024, the 22% bracket starts at just $44,725. Carol's income didn't drop by half. Robert's Social Security went away, yes, but Carol kept the higher of the 2 Social Security checks, about $38,000. She still needs roughly the same amount of money from the IRA to maintain the house, pay the property taxes, cover the bills. So her taxable income as a survivor is around $55,000. Same life, same house, same expenses, but now a huge chunk of her IRA withdrawals are getting taxed at 22% instead of 12%. That is a 10 percentage point jump on every dollar over that threshold. Over a decade, that bracket ambush alone cost Carol more than $8,000 in pure excess tax. Trap number 2, the standard deduction haircut. When Carol and Robert filed jointly, their standard deduction for 2024 was $29,200. The moment Carol started filing as single, her standard deduction dropped to $14,600, cut in half. That means another $14,600 of her income is now exposed to taxation that was previously shielded. At her new elevated marginal rate of 22%, that haircut costs her about $3,200 a year. Every year, for the rest of her life. Trap number 3, the Social Security taxation spike. Here's one almost nobody sees coming. The amount of your Social Security that gets taxed is determined by something called your combined income. That's your adjusted gross income plus tax-exempt interest plus half of your Social Security benefits. And there are 2 thresholds. If your combined income exceeds the first threshold, up to 50% of your Social Security becomes taxable. If it exceeds the second threshold, up to 85% becomes taxable. For a married couple filing jointly, that second threshold is $44,000 of combined income. For a single filer, it is $34,000. Carol's combined income as a widow easily exceeds $34,000, which means 85% of her Social Security is now federally taxable. When Robert was alive, they were just barely brushing that joint threshold. Now Carol is deep into the taxation zone on a single filer threshold that's $10,000 lower. More of her Social Security is taxed, and it's taxed at a higher marginal rate than before. Trap number 4, the IRMAA cliff. We talked about IRMAA, the income-related monthly adjustment amount for Medicare, in another video, but here is what most people do not realize. The IRMAA thresholds for a single filer are almost exactly half the thresholds for joint filers. For a married couple in 2026, the first IRMAA surcharge kicks in when your MAGI exceeds $218,000. For a single filer, it kicks in at $109,000. So if Carol and Robert had been taking larger IRA distributions, or if they sold some stock, or if they did a Roth conversion to manage future RMDs, they could have stayed under the joint threshold fairly comfortably. But now, as a widow, Carol hits the IRMAA cliff at half the income. Her safe zone just got cut in half. One large withdrawal, one unexpected capital gain, and she is paying hundreds of dollars a month in extra Medicare premiums. Trap number 5, required minimum distributions with no tax relief. Carol is 68. In a few years, she will be subject to required minimum distributions on that $1.8 million in retirement accounts, and those RMDs are calculated as a percentage of the account balance. The IRS does not care that she is now filing single. The RMD is the same, but the tax bill on that RMD just went up because she is now being taxed in higher brackets with half the standard deduction and lower IRMAA thresholds. The RMD forces income. The tax code punishes that income more severely than it did when her husband was alive. Trap number 6, loss of income, not loss of expenses. Here is the cruelest part of all. When Robert died, Carol lost his Social Security check. Household income dropped by about $27,000. But did her expenses drop by $27,000? No. She still lives in the same house with the same property taxes. She still heats the same square footage. The insurance is the same. The HOA fee is the same. She is one person eating instead of 2, sure. But the grocery bill did not get cut in half. Studies show that a surviving spouse's expenses typically drop by only about 25% to 30%, while household income often drops by 40% or more. So Carol has less money coming in and almost the same money going out. And to make up the difference, she has to pull more from the IRA, which triggers more tax, with higher rates, with less protection. You see the trap now, don't you? It is not one thing. It is 6 things, all compounding on each other, all activated by the same trigger, the death of a spouse. Let me add it up for Carol, because this is the number her advisor never showed her. Over the 10 years following Robert's death, compared to what she would have paid if Robert had lived and they continued filing jointly, excess tax from the bracket ambush, approximately $8,500. Excess tax from the lost standard deduction, approximately $32,000 over 10 years. Additional tax on Social Security benefits, approximately $6,000. Potential IRMAA surcharges. If she needs to make a large withdrawal or required RMDs, push her over, conservatively $3,500. And the intangible but very real cost. She's drawing down the IRA faster to cover the same life, which means less compounding, which means a smaller cushion in her 80s when she might need it most. Add it together, and you are looking at over $40,000 in pure excess taxation and lost growth over a decade. $40,000 that would have stayed in Carol's pocket if the tax code treated widows the way it treats married couples, but it does not. It punishes survival. Now, I want to hear from you. Drop a comment below and tell me, have you lost a spouse, or do you know someone who has? And did you notice the tax bill go up even though the income went down? Have you ever looked at your own plan and asked your advisor what happens to your surviving spouse's tax situation? I read every comment, and I want to know if this is landing the way I think it is. Now let me show you what Carol and Robert could have done differently. Because the people who understand this trap do not just sit and wait for it to spring. They disarm it years in advance. And the strategy is not complicated. It just requires you to know the trap exists. Here is the core principle. You equalize the tax burden while both spouses are alive so that the survivor is not left holding a tax time bomb in a single filer world.